Good morning. My name is Scott Forcino. I'm an associate broker with eXp Realty out of New York City in the metro area. I founded PlugIntro to solve the problem that we don't have enough people to meet and we don't have enough value to offer. And to this end, PlugIntro offers you the best way to get more and better referral partners. I have with me here Jason Ramirez from Citizens Bank. There's a very well-rounded guy, a lot of social and athletic and cool things and professional things we're going to hear about. And so good morning, Jason.
Good morning.
Here. Great. So tell me about you, and I mean, how long you're in the business. Tell me what's going on in the mortgage world. There's so much going on with rates and programs and how buyers are using and adapting. What can buyers do and what can you do for buyers and agents?
Okay. Well, good morning, Scott. Thanks for having me. I've been in the business 17 years. I started, back in the original refi boom days. And I started at AmeriQuest, went to Washington Mutual, Wells Fargo. I spent a good chunk of my career, and now I'm 7 years here at Citizens Bank. So it's been great. I don't really like jumping around because, the grass is obviously never green around the other side with a lot of these lenders. But the truth is, I'm really happy where I am right now. I could offer, tons of value to people because, I've been around. I've been in finance prior to that. I was a financial advisor on Wall Street prior to that. So I do have an expanded knowledge of markets and how they work in terms of interest rates, more so than just like, opening the newspaper if people still do that, or, just logging on to Bankrate and seeing what today's rate is. I could offer a lot more on how to show people to really understand how rates work. And then, that type of added value, I think, it helps people when they're shopping for rates. At least the people that come back to me constantly, they do what we talk about and how I tell them to view it, and they get it, and it's pretty good stuff.
Well, before they need a rate, they need a mortgage. So, I mean, I know they always put that cart before that horse. I mean, how does that work? I mean, how's the rate derived based on different buyers' qualifications and profiles?
Well, rate isn't one size fits all. So, there's so many variables. There could be dozens of variables that constitute a rate. But, more times than not, when people call and they're looking for a rate, you gotta be specific. If you're not looking to do an application for a pre-approval, you got to be specific. You got to, credit score, property type, estimated purchase price, estimated down payment. Those are the big ones that'll give me a baseline on what type of rate I can give you. In terms of, qualifying, I'd have to dive deeper. They would need to do an application so I can collect documentation and do an income review and asset review and be, pretty sure as to what you can actually qualify for. A lot of people will call and they'll say, hey, I make X, Y, and Z per year. What can I get? It's really not that easy. There's so many variables as how much credit do you have, how much this, and, one thing is for sure, not everybody, people gently exaggerate about what they make, what their credit score is. I call it gentle, but it can,
It's funny. I mean, it's like telling the doctor. People lie to their doctor. Why lie about your weight? Why lie? They're on the scale.
I mean, it happens a lot. They'll think that the bank won't find out, or whatever the case may be. So when people are rate shopping, and when I'm talking to new buyers, I kind of really tell them, looking for rate is it's almost like gas prices. I call it, like, it's nominally different at every corner. And that's what rates are. They're nominally different at every bank. For the if you're going with an A paper lender, of course, if you're going with a top tier lender, if you're going with any type of mortgage bank or a broker, that's a different story. But so when people are constantly calling looking for rates, and there's a lot of variables. So I really try and educate the customer on how to properly do it. More times than not, it does stick. You take a pre-approval, you submit documentation, and this is a live, this is, this pre-approval with documentation is it's live. This is your loan, basically. The only difference is there's no address plugged in there yet. Those are the differences. But, that's that's how we try to not waste time, because there's a lot of time being wasted. People will call looking for closing cost number. That's another like giant, I think, waste of time in my opinion, because closing costs are, 80% of them are universal. They're
And that always
dictated by third
bothered
parties.
me. That bothered me as a lawyer practicing in this field, where people say, "What's the closing costs?" And I always said, the bank's one part, the title, the taxes. What about the oil? I've seen people put in 900 gallons of oil in June. Did you know you're going to have to come up with $3,000 for those 900 gallons? I mean, that's a closing cost. You're not buying the house without it. So you talk about a variable, and then you don't know attorney's fees, and you don't know if school taxes are due. That's another $4,000 if it's coming up on September. So how can the banker give closing costs?
Well, I think it's best to describe how closing costs work to the customer. Okay. So I often tell them, listen, it's broken down into 4 sections. Okay. Predominantly 4 sections: bank cost, title cost, interest, and escrows. Those are the primary costs. Okay. The bank is what it is, that they're kind of, whether you're going to pay points or not pay points, they're usually the smallest part of the overall cost. Okay. Title being the big one, because title can constitute of 12 to 15 different costs, mortgage tax, depending upon, if the property's over $1 million, it could be mansion tax being thrown in there. So that's usually the biggest part of the cost. Okay. And then there's interest and escrows, and then you explain to them how escrows work, and that could be taxes that have to be picked up, because what time of year you close will depend on what your escrows are going to look like. Period.
Mm-hmm.
I mean, that's another thing. If you're closing and taxes are due inside of 60 days, guess what? That's going to be your cost if if it's inside of 60 days.
Even the time of the month you close, it could be
Yeah.
it could be another month payment, but you're skipping a month. People don't want to hear about skipping a month. It's just more money, right?
There's too many. The breakdown is it's not just blanket. Hey, your costs are 20 G's. That's not the case. So I try to really describe to them how closing costs operate. 1, 2, 3, 4: bank, title, escrows, per diems, and that's really the nut and the meat and potatoes of it.
I hear you, but that always bothered me. You're playing first base, and they're asking you about all the other positions' costs, and it really is upon. That's why people don't in New York. It's lawyer based. They should speak to the lawyer first, and they don't. They speak to the lawyer last.
Well, because they think the lender controls everything, and then you tell them when you get a good faith, actually loan estimate now it's called, from bank to bank, they're all going to be slightly different. The cheapest one shouldn't win, because at the end of the day, whoever your attorney orders title from is going to trump every cost I put there anyway.
Of course,
including what time of year you close and what time of the month you close. That's going to determine your short-term interest, all this good stuff. So, I mean, it's really more about just educating them, when they call and they say, hey, what is this? And, I break it down to them, and I just educate it, and I try to nip it in the butt. So that one, they'll stay with me, because they'll, I try to bring the wow factor into it. Like, whoa, this guy really knows what he's talking about, really breaking it down for me. Just to give them an understanding. I try to give them the benefit of the doubt. This is how it works. And, you're probably better off just choosing one, maybe going to 1 or 2 different places, and, just don't bounce around to 6, 7 different places. I've seen that before. People bounce around 6, 7 different places, and you're really wasting your time.
Can you hurt your credit by bouncing around like that?
Well, yes and no. So if you're okay with getting a pre-approval done per lender, because again, with me, I don't blanketly tell people this is what it is. I try to really, I want to bring them into my financial ecosystem, basically, right? So I want them in. But if they don't want to run credit because they ran it before, you can technically run credit a couple of times when you're looking for a mortgage inside of a 21-day time period. The algorithms of these credit agencies understand it's your right to shop for a mortgage. So, and they understand that mortgage companies or banks for that matter, need to run credit to accurately, quote the customer. So, inside of a 21-day time period, it won't affect you. Beyond that, yeah, you're gonna start getting dinged on your credit and stuff like that. But you really don't need to run your credit 4 or 5 times. Even if it doesn't hurt you, you really don't need to run your credit 4 or 5 times inside of a 21-day period, because you're going to get a nominally different quote everywhere you go. And at the end of the day, it's going to be all dependent on, who your attorney uses title, who he or she orders title from. And then the rates change daily, sometimes multiple times a day based on treasury yields. So that's another thing, so what I quoted you today or last week may not be the same.
So tell me what's going on. I mean, I know that I have a friend in Florida where he had a great rate and he's been extending it $100 a day, which seems low. Mm-hmm. So I know that banks have now cut back the lock-in because people are still closing at those rates from 2 months ago. But I guess we're getting to the end of that. And what are banks offering for lock-ins now?
So traditionally, banks do 60-day locks because that's traditional. You can do a 30-day lock, which is slightly cheaper in terms of pricing, not so much rate, but that's a little too short. Banks want no less than 60 days on the lock. Now, prior to, let's go into the COVID time period. Banks were, Citizens was locking for 90 days flatly, and then extending at no cost. These were COVID rules because of the volume that came in. A lot of these banks couldn't commit to the dates, the closing dates, because the volume was just absurd at one time. So, and there's just so much, there's people at the other end of these transactions, many hands touch a loan. So they, banks were, at least Citizens they were locking for 90 and extending kind of cost free for a while. So now that cost free is gone. Okay, because the volume is nowhere near. I mean, if you just turn on the news once, you'll know that the volume's nowhere near where it is, where it was in 20 and 21, especially 21. So banks are now cutting back to probably more traditional 60 days, and then they're charging the borrowers if they extend beyond, if they have to extend beyond that for the rate. So,
and how far can they extend past that 60 or not?
You could extend indefinitely. It just starts costing money.
I didn't realize it definitely.
I thought weighing out the economics.
I thought the banks were saying that they're not going to go past 90 anymore. I heard that too. Maybe I'm wrong.
No, they'll extend. They'll definitely. I mean, look, if it's a live loan, if you're having a CO issue, a permit issue, a seller issue, anything issue, they're not going to kill your rate because of that. They'll just extend it beyond that. Where a bank will be concerned about extending is if it's just an indefinite extension with no clear direction on the loan.
So that means someone could close today with a loan with a rate that's from really March or maybe even February. Maybe March.
Yeah, 100%. I mean, if the delays are, warranted, more times than not, nobody's just sitting on a mortgage just to sit on, just to watch.
Yeah, it could be, like we said, underground storage tank. It could be something like that that's out of your hands.
A bank will extend. They'll extend.
Does the bank lose when that happens? Or
they lose if the deal isn't closed. That's if it closes, they don't lose.
That means there's got to be people this weekend at cocktail hours saying they got a 3.25 rate, and their friends are saying, "How do I get that?" You can't.
I mean, you do get a lot of that. You do get a lot of people that are, that they have they're bragging about rate with it. I am closing loans with that. With borrowers were in the threes. They were locked for an extended period of time.
Wow.
Yeah. I mean, but again, that number is really dwindling down.
Sure. Less than Mohicans, right?
So now it's more of a normalized situation. Where people will be in the 4s and in some cases even the 5s, depending on the.
And so purchasing power. I saw some crazy. I'm going to have this wrong, but I saw that $3,500 in January got you something like $770 loan, and now $3,500 gets you like $680 or something. I mean, those are ballpark. So, I mean, that's really people who are, their monthly budget conscious. So what happens then? I mean, they could be actually out of deals, or the DTI could be way out of whack. Are you seeing that?
Yeah. So people that, a 1 point rise in rate can make a difference. And the people that are really getting affected by that are the ones that were on the cusp. So to your point, that 770 purchase or loan amount, okay, if people were maxed out on their DTI at, let's say, a 3.5, just picking any rate, now at a 4.5, you're above the DTI limit. So you either have to A, put more money down, or B,
Buy a cheaper house. Right.
You know, so that really, that's the purchasing power that's being affected.
So if I'm correct, the loans like FHA that were allowed a higher permissible DTI, and that means debt to income, you could explain it. But so people were on the back end like 50 plus, right? 50 or 52 or something.
Mm-hmm. Yeah, well, FHA is unique, very unique when it comes to DTIs. They can go the highest in the industry. But yeah, like they're also being affected, because if you were, again, 51, 52, you know, these things have to, you know, when it comes to be approved for a debt ratio that high, the system has to automatically approve it. You know, that can't be like a manual underwrite. Usually manual underwrites, they don't approve them that high. Okay. There's a cap on the DTI. So if you're 52, you might not get approved at 52.5. The system may reject it. You know what I mean? So yeah, it's tough to determine.
But people could really been losing houses. Now, what if someone's in a contract and they didn't lock? That means they qualify and they don't qualify.
Yeah, that's a problem. You know, that's why you really have to have you really have to have a lot of self-awareness when it comes to, you know, what you qualify for. And if you're just waiting for that, you know, the rates to come down, or the next big, you know, dip in the market, which might not happen for a while. I mean, you know, let's consider why rates were so low in the first place. We had a pandemic, the economy shut down, there was quantitative easing was insane. So yeah, rates were artificially low. I mean, unless something of that nature happens again, I don't see us getting to that point again.
And we sure hope not.
I mean, yeah, certainly not. But you know, unless something like, you know, you're not going to get those cheap rates anymore. So this is the new reality. You know, there's going to be an adjustment period in the pool of buyers that are out there. So, you know, to the earlier point, that 770, you know, that person that seller at 770 may have lost the pool of buyers. So if you have 20 people, now you have 12. Because
that's happened to sellers. That's why prices are coming down.
Right.
Okay. Well, you know what? The rates are important, but it's not the sexiest subject. I mean, to me, the sexiest subject is, you know, getting the clients and how that works with networking and providing value to your referral partners. So what's been your method? I mean, the key to your success to put you in a position of really doing a great job in the market?
It goes back to my earlier point. I try to educate everybody that I speak to, give them more of an insight as to how we see it on the bank end, especially a referral partner, or, you know, any partner for that matter. I try to really give them an idea as to how everything operates. Okay. I've never actually, I don't sell. I'm myself. Even, you know, on my Facebook posts, I'm myself. You know, it's what I do. I don't have a selling cap. I just like to, I put it out there. I just educate them. And more time, it's worked for me for well over a decade. You know, people, especially with referral sources, and you know, people tend to always come back. You know, they watch how the markets operate. They understand DTI. It's crazy that there are people that really do listen and want to know how it works. You know, they just, you know, and they come back, especially the realtors I work with too. They understand DTI. They understand credit score. They understand, you know, when they're coming to me with a customer, they you know, they break down, hey, this is their rate. This is their credit score. You know, this is the property type. You know, they make around this amount of money. What are your thoughts? You know, and then, so they come to me with the right questions, and I can kind of give them a little bit of an idea as to what it's going to look like, you know, on the surface, basically. You know, it's not just a blanket, you know, hey, what's the rate, and, you know, stuff like that. And, you know, so that's really what it is. It's just providing knowledge on how the markets work. And
would you hold on 1 second, please?
Sure.
Yes, Barry. Can I call you back in about 15 minutes? Unfortunately, I'm on a call. Can I call you back? Thank you. We'll do. Bye-bye. We'll cut that out of the video here. Sorry about that. Well, I mean, working with realtors, I know it's critical to the lending industry because they're the chief referral sources. What's been the joint or the opportunities to collaborate with agents to further your collective success? I mean, other than meeting and greeting, what are the things that you've seen others do?
I work with a limited amount of agents. So, I don't market the way I don't go to open houses much. I don't do much of that. Although I'm always open to it. I do have a limited amount of people that I have worked with, but that I do work with still. But I believe more in marketing to my own book of business. 17 years, and I've closed a lot of loans every year, a lot. So I just tend to market to these people and attorneys and a lot of, believe it or not, financial advisors. I work with a lot of them, partially because I do speak their lingo, because I am a former financial advisor myself. So I speak their language. So I click pretty well in that circle. That being said, I mean, that's really, I just continue to market to my book, and I continue to talk to just every day. I pop in and I speak to them. Not so much pop in. I'll shoot a text, shoot out an email, and I'm constantly in their face. Even with my marketing, I'm constantly email blasting. Even if my email gets deleted, they see it and then they delete it.
I call that top of mind awareness. And for someone like you, you may not struggle from some of the other things for newer agents or newer loan officers. Or even myself, my problem was always I didn't have enough people to speak to. If I had 60 sellers in a room, then I would impress them by my background and my abilities. But I don't have 60 sellers. And even if I did have 60 sellers in a room, it would be a room for that day. I wouldn't be able to carry it around. I wouldn't be able to have immediate and constant access to it. And I also did not have something to provide them. And I think this is big in the real estate industry, both lenders and the realtors, is enough value. And people say enough value if you're good at what you do. And I say, yeah, but you're only good at what you do when you're doing it. If you're boxing or running like you do, you're not boxing or running right now. You're not a great boxer. You're not doing it. So if you're in a deal, yes, you could be good. But when the race is over, you got to wait for the next race. You can't keep running. It's over. I'm using your language. So you're doing it, then you stop doing it. So you're only as good as your last race. That's true in business too, where I needed something. So I formed this platform, which I'm sharing with people I know, where we're able to give your contacts and your colleagues and your referral partners a chance to promote their business. And as far as I know, it's never been done. There's never been an opportunity for anyone to provide anyone else in the real estate industry or outside the industry with a place and a way to promote your business. So we sliced off a piece of Facebook, which is ours. PlugIntro is ours. When I post on Facebook about, something fun or a sunset or a meal, that's cool. People like that. But if you're promoting yourself, you're competing with everyone else. The post is only 2 inches. It requires a lot of reading, and your competition sees it, and you're not special because you didn't give it to anyone at all. And specifically, you didn't reach a target market or even share with people that they may need it. Imagine putting something on social media and they miss it because they're at work or they're sleeping, and then they could have really used it. Well, PlugIntro has the opportunity to create the content you're doing, which is professional and high level in nature, and then you select your audience. So you would be able to reach your intended referral partners like agents or financial planners or lawyers, give them this information. But I think more valuable, which is the dirty little secret, is that those financial planners and lawyers, et cetera, may want to be heard themselves. So you're the one that gave them something of value. That's what you provide, is this opportunity for them. So I'm surprised no one ever did this. That the key is the content, where now you want to share your information and your proficiency, but even more so is the point that you now give them something they never had. So really the point of PlugIntro in one phrase is to cultivate reciprocity.